You're on board KCAA's Inland Talk Express. KCAA, Loma Linda, 1050 AM, the station that leaves no listener behind.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for listening to us each and every week. Coming to you from KCAA in the Inland Empire. We've been with them for a number of years now. I want to thank everybody over there, Fred and Mark and everybody else who works at the studio to bring our signal to you. We're on FM. I don't know. What is the call letter to the FM station? Do you know?
It's, I don't know.
I don't know. Do you know the numbers?
They just call it KCAA.
KCAA.
So a couple of FMs, yeah.
Yeah, I mean, we're on the dial, absolutely. But if you're at home right now, get in front of your computer, look up KCAA.com. If you do that, you'll see exactly where they are on the dial, AM and FM. Also, we are in their archives. So if you haven't seen or heard the show before, you can go there and find our show and listen to some past episodes as to what we try to do. And so in that, we try to bring you information you might not get anywhere else. We're not trying to sell you anything or do anything to make you feel anything but informed. That's been our philosophy since we started the show. I, too, am a mortgage broker, mortgage lender, have been for 25 plus years, and bringing news that you can use, information about loans, loan products, rates, certainly what's happening in the overall economy. These are the things we do on the show, and we do it each and every week. If you want to see the show, because we shoot it for video as well, you can go to YouTube. If you go to YouTube, it's Jeff Barton, the Mortgage Voice, and that, as I said, has, hundreds of shows, past shows, plus the current show. TheMortgageVoice.com is our website where you can see the guests that appear on the show and also listen to some segments and contact the guests directly if you are of a mind to do so. We bring on the show account executives, loan officers, real estate agents, professionals in the area, as well as occasionally we can bring some special guests to talk about community involvement or other things that are important to my audience based on where you live and what's happening in those neighborhoods. Anyway, I am Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, so we have had by the time you hear this show, you will have known that the Fed will probably halt their raising of the interest rates for at least a month or two. The CPI, the core inflation numbers have come down, and we're pretty excited about that. We've seen a bit of a rally in the stock market as a result, meaning that if in fact we do see a pause in the Fed rate hike, we won't see any additional raises in costs of doing business with major banks. Obviously, as everybody in my audience knows, and if you're new to the audience, you'll now find out, the interest rate that the Fed charges is not the same as your mortgage interest rate. There are tangential issues that go into that calculation, but they are not connected at the hip, so to speak. So if the Fed raises their short-term interest rate by a quarter point, 25 basis points, doesn't mean that correspondingly the mortgage interest rate is also going to go up 25 basis points. And a basis point is 1% of 1%. So if you have 100 basis points, that's 1% of your mortgage. So if you have a 6% mortgage, that's 600 basis points. Just so that you know that when we're talking about the two, they are connected, but they aren't necessarily dependent on one another, i.e. if costs are lifted by the Fed raising their short-term interest rate, i.e. the amount that the Fed charges or between banks. So if one bank borrows in order to lift their liquidity requirements, the liquidity requirements on major banks, Citibank, Wells Fargo, Bank of America, JP Morgan Chase, all of these banks, and there are many others, have to have a certain amount of money in the bank at the close of business each day. If they don't, they got to borrow the money, and that's what the Fed interest rate really dictates. Now, that affects you in your credit card debt, absolutely. It affects you in your car loan debt, absolutely. Any short-term debt that isn't anchored to your mortgage, i.e. that is a real property, you're going to find that the Fed interest rate, when they raise it, is going to affect you. The mortgage interest rates are really tied to the bonds, as we've talked about many, many times. The 2 and the 10-year are the competing bonds in terms of whether we're going to see a recession or not, and everything else thereabouts goes to what we discuss on a daily and a weekly basis here on the show. So when we're talking about long-term effects of something like COVID and what it had on the markets. Now, we don't talk about COVID the way we did 2 years ago, but we do talk about it in terms of what it has had effect on inflation, let's say, or the availability of funds, or the unavailability of properties because there are just not any out there that you can afford to buy or available to buy at any price. And this, as a result of all this macro stuff that we're talking about, has made it difficult for you, the consumer. You're out there right now, you want to buy a house. It's in that season whereby school is ended and you may have to relocate and move somebody somewhere else. Maybe your folks or you even are downsizing. They want to sell a house but buy something smaller. And maybe they want to move cross country. There's a lot of reasons why people move and buy and sell houses, but it's done right now, and you're out there right now trying to figure out exactly how you're going to be able to do this. This is the place where you try to sort that out. Certainly what I'm talking about today is really macro stuff, and that we talk about it to sort of outline or sort of show you exactly what we're doing in terms of what the Fed has done today and what the core inflation rate, what the inflation rate means, and then you make better decisions. And those better decisions may help you say, hey, look, I can afford this because I know where the economy is heading. The economy is actually doing pretty well. We are approaching that time of the year where we're going to get Q2 in at the end of the month, and it looks like we're growing the economy. I say all of us, anybody who buys and sells anything, is helping the economy grow to 1 to 2%. Could be coming in even a little bit hotter than that. Now, I say hotter because that's the buzzword when we talk about inflation. It means that, yes, we're growing. The fact that the Fed has raised their short-term interest rates on interbank lending has really not affected what's happening out there in the marketplace, meaning that the economy is still growing. It's not growing to 2.5%, 3% like it was, but it is growing, and that's a good thing, and it's a good thing for you, the consumer, because it means we're not going to have the job layoffs that we were predicting. We've had many job layoffs in tech. We've had many job layoffs in the real estate world, i.e. 1 in 9 people, as everyone knows, works in the real estate sector, whether it's mortgages or real estate agents or developers or inspectors or, escrow agents or title agents. All of these businesses, there are many, many millions of people that work in these businesses, been really affected, but those layoffs have really run their course. A lot of lenders are looking to when interest rates will fall, even if they... Look, we're at let's see this, 30-year interest rate at 6.97. So let's call it 7% for the most part. If you have excellent credit, and I mean over 800, 740 to 840, right? If you have that kind of credit, if you have 20% down, if you have a number of assets that you can draw upon, you're going to get the best rate. And the best rate today is about 7%. Now, you may be able to, if you're working with your own bank that you have all your money with, get a lower rate. Sure, I don't say that you can't. But for many people, the regular rate that we're quoting here, 6.97, is an average of rates across the country. You might do better, but most of you probably aren't going to do that well. So you're going to be paying in the 7s. That is a big pill to swallow. I mean, let's face it, it means that your average monthly, if you're going to buy a $500,000 house, that means that, okay, that's $700 per 100,000, that's 7.5, okay, that's $3,500, and that's just simple interest. So you're probably paying with taxes, interest, everything else, closer to $4,500. That's a lot of money. That's $4,500 times 10 is $45,000, $55,000 a year just on your mortgage. So you got to be making it 50% DTI, at least $100,000 to $110,000 a year. Okay, how many people can't afford that? Yet, how many houses out there are at $500,000? Not that many, especially if you're in San Bernardino and Riverside counties. Looked it up. The median home price, I think, in Riverside County is about $750,000, $47.50. San Bernardino, not too dissimilar. So this tells you that it is expensive out there, and I understand it because I'm in the business that went from extremely busy during COVID to a business that, as I said, has had a lot of layoffs, and that affects many, many, many people. Anyway, we'll get to it a little bit more. We've got some great guests for today's show. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to us each and every week. We come to you via the KCAA radio signal, AM and FM. Really appreciate everybody out there listening. If you want to see us and hear us, you can go to YouTube, Jeff Barton, the Mortgage Voice. Go to themortgagevoice.com. Go to any number of different podcasts that we're on out there. And also, if you want to follow me, you can do that at Jeff6493. That's my Twitter handle. And, I don't know, is there anything else? No, I think that's it. Okay, so each and every week to bring to you the best and high-quality information about what's going on in the loan business, we bring a variety of different people, but we also bring back favorites of ours just because of their knowledge and the expertise in the business. Tomas Trujillo from Ameritrust is just one of those people, and he joins us now. Tomas, how are you?
I'm doing great, Jeff. How are you today?
I'm fine. Thank you very much. Physically good. Business is still, well, we may see a little bit of a reprieve if we get the Fed to not raise rates, which I think will happen. So that'll be good. And hopefully mortgage markets will follow that suit and come down a little bit. That will help us any number of different ways. What's your opinion?
I believe so. I think now we have there's another shark in the ocean that I think might start hurting us, and that's insurance.
Yep.
I don't know if you know, but
I do.
A lot of insurance companies are starting to drop people in California. They want out of California. Some people's insurance, if I believe it was 1.2 and above, your insurance might actually double. It'll go up 100%. Other people who are in fire areas, they're looking at maybe 30 to a 50% increase in their rate. So it's getting a little crazy out there, but I'm hoping that the rates come down so it'll balance that out. Because, wow.
Okay,
crazy out there.
What's your opinion on greedflation?
You got me because I have no idea what that is.
Okay, so people that don't need to raise prices the way they're being raised because they're greedy, and it's called greedflation. I think the insurance companies are so at fault for this, but nobody does anything about it. Don't know if there can be anything about it, but your opinion on it in terms of what we do.
Well, I think they've. I know that they had a huge loss because of all our wildfires, our flooding, all the natural disasters that we've had. I think it was last year they had a $4.2 billion loss, and they just can't make it up. I know that they've been after the insurance commissioner to let them raise the rates, and they're trying to do it back as far as 2020, but they were saying no, you can't do it. We can't raise rates in a pandemic. So they've been biding their time, and I think they finally got the okay, so they're going to start doing it. I don't like it, but you know how CEOs are. They need a bigger boat every couple of years, so I guess we're going to have to pay for it for a little bit. But I believe it's not a long-term thing. From what I understand, it'll be around for a couple of years, and hopefully it'll come down as soon as they start recouping some of their losses. Because this is California. You can't stay out of California.
No, I mean, obviously, we have a lot of drain of population, but there's still 40-plus million people here in California. That's not going to end anytime soon. Southern California is awesome, great place to live. Tell us about Ameritrust and some of the products you might be giving to these consumers. Most popular ones would be?
Would be our DSCR. We're doing DSCR loans where you don't have to show me any income. We'll take the income from your non-owner property. You do not have to be a seasoned investor with us. You can be a first-time investor. You can even be a first-time home buyer. You can be paying rent somewhere and decide, I want to buy an apartment building, and you go out and you buy an apartment building, and you don't show me any kind of income. I'm just taking the income from the apartment building.
Okay.
That's one of the hot things that's going on right now. I-10 is a crazy loan right now.
Right.
You have a lot of people who are out there that couldn't get a loan before. Now they're able to get loans. You don't have to give me full doc. You can give me bank statements. We'll take P&Ls. It's an open market. It's time to go shopping.
Okay, so availability of property is always an issue. When you are approving somebody for this type of loan, is there any pre-approval that you can give people in order to get into a property, possibly beat out the competition?
Oh, 100%. I think I did one for one of your loan officers earlier today.
Okay.
We did a DSCR. I gave him a pre-approval. I basically told him, here's the open checkbook, go shopping, and let's go.
Okay,
100%.
Yeah, no, that's excellent, because, it's one thing to find a property that you can afford, but to be ready and able to make an offer as soon as you see something you like is really an advantage for those people that have that kind of power in the approval that they get. What kind of approvals are you giving? Is it DU approval? Is it more like a manual underwriting approval? What is it?
So what we'll do is, if you're going for any of our non-Q products like the DSCR and I-10 mixed-use property, then we will give you. DU won't approve that.
Okay.
So what we'll do is, I'll give you a manual approval. We'll go ahead. I'll send everything to the underwriter. She'll give it the blessing, and then we'll write you up a nice little. Hey, you're pre-approved for this much. Go out and go shopping. Or if you're going to go FHA, conventional, VA, we can do a manual. We'll do an AUS approval, and we'll send you that. And again, go shopping.
Okay, in these DSCRs where you have how much down and what are the credit score requirements?
So on a DSCR, we're down to at least a 660,
Okay.
20% down,
Okay.
10% of your own money. The rest can be gift, seller contributions. Doesn't matter where it comes from. All you just need 10% of your own money.
Okay, so because you said you just approved one for the company Malibu Funding that I work for. What exactly in terms of the amount of money that you can lend?
Oh, we'll go up to $3 million on that one. I think the one I did for you today was $1.5 million. The borrower was coming in with 10%. He was getting a 10% gift from a family member. And actually, I believe it was a mixed use. It was a DSCR. It was 4 units on top. It was a storefront on bottom. It was in Huntington Park, where you get a lot of that kind of property out there.
Wow, I like that idea. Yeah.
Oh, 100%. It was a first-time home buyer. The guy had moved out of his house about living with his parents a couple years ago, paying rent, and he decided, I'm going to go out, I'm going to buy a place, I'm going to start making my fortune, and that's what he's doing.
So the underwriting guidelines here are the property has to pay for itself, right? Or can there be some negative there?
No, well, it can be negative. You can go down to 80% negative.
Okay.
So actually 20% negative. So if you're using simple numbers, if your mortgage payment and property insurance and taxes is going to be $1,000 and your rent is $800, we will still do that loan for you.
Okay, good. And the stipulations of mortgage insurance or any other kind of protections for the lender, what are they?
We have our mortgage insurance. We go through MGIC.
Okay.
Actually, if you're going to go 80%, we're not going to ask you for any mortgage insurance. It's not required on it.
Okay, that's like an FHA loan then.
Correct.
Okay, excellent. Now these products, because they're available, I guess, for everybody, are probably the most popular ones out there today, just because you can get into these properties without necessarily having to, prove income. Is that right?
Absolutely. Right now, since income is fun, it's tight. People are, they don't want to give Uncle Sam all their money.
Right.
So yeah, they want to kind of hide it a little bit, and so that's where this program is perfect for them.
Okay. Anything new coming up this summer? Because now we're getting into the summer months, and everybody is hot to buy a property now. Looks like the real estate prices have steadied and may even begin to climb again.
I sure hope so. Well, what we're looking at right now is we had at the company I was with last, we had a lot of Chenoa and Calhafa loans, but those were getting kind of tight. They were getting a little too stringent, so we went with another type of down payment assistance. It's kind of like the Chenoa, but we have a little more wiggle room.
Okay.
The pricing is going to be a little better. I can't announce what it is yet.
Oh, okay.
But
Good
we'll
tease.
go down to a 600 FICO. You do not have to be a first-time home buyer. It has some good little twists and turns here.
Okay, excellent. So we've got new products coming up, i.e. the down payment assistance program. Always popular, especially for those people who are looking to go either, is that also on a DSCR or is that just a single family?
That'd be single family right now.
Okay.
Single family, 1 to 4.
Okay. Hey, could you shout out a way by which people can get in touch with you on these great loan products?
Oh, absolutely. My name's Tomas Trujillo. You can always get me through Jeff at Malibu Funding, or you can give me a call at 323-228-5181.
Excellent. Tomas, I really appreciate you coming on. Thanks very much. I always enjoy the conversation.
Likewise. Thank you, Jeff.
Thank you very much. That's Tomas Trujillo, and he works for Ameritrust. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. If you want to see and hear this show, you can always go to YouTube. Jeff Barton, the Mortgage Voice, is a great place where you can see. We have archived there hundreds of shows over the past 9 years where we've been doing this show. The market has changed dramatically over the last 18 months. If you were to set back a 3 years to today, probably not so much of a change. Even at that time, we had rates in the 5s and 6s. Currently, the rate is almost 7%, but it's volatile and it's up and down over the last 3 months. But during the COVID years, that was a remarkable time. It has really infected and impacted what we're doing now. And I bring on the show people who know way more about it than I do. Blake Adams from Accelerate is one of these people. He joins us, hasn't been on for a while, but I'm glad he is. Blake, how are you?
Thank you for the nice introduction. I appreciate it.
No, thank you very much. Okay, so given that we have this volatility in the market, although albeit it's slowly rising, kind of like when the ice melts in Greenland, the seas are going to rise. That's the way we see the mortgage interest rates. Where do you see that happening in the near term and maybe 6-7 months from now?
Well, I'll tell you what, that old Chinese proverb that may you live in interesting times, I think we could define these times as those times. And ultimately, I personally analyze a lot of geopolitics as well as just, the overall market. And I think that America is always going to be a place that based on our population and not, and having, our protections the way we do, I think that real estate's always going to be an option.
Right.
And the best thing about a tangible asset in times like these is real estate's one of the few that we can actually use leverage, right?
Yep.
And so that's what I would recommend to people is think about what you want to do in this future of holding on to real assets. Some people are getting coins, some people are artwork, whatever and the real is that in the mortgage business, we have the ability to help you get into whether it's the non-QM space where you have a borrower that can't prove his income but has great credit and can pay you back. We got loans for that, and we also have the debt service coverage ratio options on rental properties. So, for instance, if you have a fourplex that you're looking to buy, and ultimately we could take the future rents that you expect based on the appraised value and the purchase price and the rents you expect, you can qualify just on those income parameters. You don't have to put up any tax returns or anything like that on our DSCRs, they call those, debt service coverage ratio loans.
Right.
And then in addition to that, we've got those things, but we're just your wholesale lender at Accelerate Capital. But really, when it comes down to it, we do what we can to make the deals work that makes sense for people that can pay the loans back. And I got a great team, excellent underwriter, always available, excellent account manager, good marketing people, and overall really good team, And so I've been there for about 8 years. And then in addition to that, I've been doing this for 30 years or so.
Sure.
And so I have a lot of contacts out there. And one of the things I'm excited about is I just had a conversation recently with a group that I've known for a long time. And they just raised over $2 billion to do construction loans, believe it or not. And so that's a lot of opportunities in the market right now.
Interesting. Commercial, and in some of the notes that I was preparing for today's show, commercial was one of these areas, especially in the inner city, in some of the larger cities that are having a renovation to units, converting office buildings into residential units. And I don't know if that's on your radar. I bring on a guy from San Diego about once a quarter to talk about real estate, commercial real estate down there and what they're doing about it. So the construction, any kind of loans out there that someone could convert one kind of building to another. Do you see any of that out there?
Yes, there is that out
Okay.
there. And really what you have is a lot of infill projects right now.
Right.
And so the financing is available for that. Obviously the loan to values and loan to costs is also important. You're not going to, you got to leverage it a little, but you got to have some skin in the game.
Sure.
Okay. And ultimately, to me that just shows that there's still a marketplace for that. And as you know, there's a lot of areas for certain pockets that it's still tough to buy a house right now.
Yep.
Even with interest rates as high as they are.
Yep.
I just had a meeting with another associate of mine, and he just sold his house in Orange County. Never even put it on the market. It was just a word of mouth. Hey, I'm going to sell my house, and he got more than what he expected for it.
Yeah, I think.
So
right. Go on. I'm sorry.
No, go ahead.
No, I was just saying, in certain pockets, I think the problem in this type of market is that you're never quite sure what the market's doing until it's already done it and it's now changing to something else. So if you're expecting prices to drop because of these either high interest rates or the threat of some kind of inflation / recession, and then all of a sudden they start rising, you go, did I miss it? What happened? And I think,
well, and you're right about that. That's why I say, use your leverage opportunities now, because also there's things to be considerate of with the budgets we have, the amount of bonds that are going to go to the street. What's that going to do to liquidity and the liquidity of the bond market? So now is the time to really take advantage of the opportunities that are out there. And so, you could have your people call me, or the best way to do that is probably text me, and I will call you back. I will call everybody back. And that number is 949-300-3112. And I'll talk to anybody, but just be patient with the calls, because I'm on the phone pretty much all day. But that's okay. It keeps us excited.
We talk about, and you talked about assets and how basically real estate being one of the soundest investments that you can make. There is such a move right now to move away from cash, to move to electronic mediums, tokenize the world. And with AI being what it is and the fear that brings to people, how is it that the lending industry is going to take advantage of this stuff while still saying, hey, look, real property is called real property for a reason?
Right. And so if you're going to have tyrannical governments or what have you, you got to guard against that. And ultimately, having real property and laws that we have here in the United States with title, it's not going to be easy to just take a property away from somebody.
That's right. Yep.
So it's always good to defend yourself and plan for the worst. Let's hope that the dollar is okay still in the future, and that the United States, stops becoming so polarized, because we're all Americans, and ultimately we should be in it for each other. And getting into that picture is all another topic, I'm sure, but I am concerned about these central banking digital currencies, and that is the thing that scares me the most, because I feel like they've already put in place, the 5G's coming, this is coming. It's all the military kind of state that is seeming to be taking place around us, and I feel like part of that last puzzle to lock us into a technocratic state, being the whole nation, if you will, is that CBDCs, because they can track everything you do, and even the head of the BIS even said not too long ago, it's on YouTube, how they can track the dollar, basically if it's digital, and they can't do that with a real dollar now. So $100 today, he says, we have no idea where it's spent.
Right.
$1,000 peso, they have no idea where it's spent. But then you have these CBDCs that they can control the mechanisms, and they can control what you spend it on, how much you spend it. For instance, if you say you have an allotment of what you could eat for steak. I mean, that's kind of interesting how you could be at the market and, oh, I'm sorry, you're at your meat your allotment already for the month. You can't buy that. That's where it could ultimately go. You got to guard against that.
Well, I think having cash is something that's fundamental, and it says right on any of these bills for all debts, public and private. And when you get to a situation where, sorry, we don't take cash, there has to be something done to ensure that the cash under my mattress, where I keep some of it, can be spent, and that people can't prevent you from using U.S. currency. I think that's really important.
Well, it is really important, and there is a lot of our currency out in the entire world, and most contracts are done in the dollar. So you see these lower level countries that they have to go and convert their currency to the dollar, and ultimately that continues to make the dollar very, very strong, and definitely the reserve currency still. It's going to be a difficult task to overtake that, I think, because regardless of what's going on in the government and the budgets and this and that, the other, we can interchange dollars as people, and it's still something of value. Okay, so I think that cash out opportunities right now on owner-occupied properties, you can get pretty good LTVs out there still.
Yep.
And you can do, there's a lot of high dollar financings. I go up to $5 million in loan amounts at non-QM with Accelerate, and up to 20 is what is available on the construction side that I have available to us as well. So,
hey, Blake, can you shout out your phone number again? We're at the end of our time here, and my engineer is looking at me like, "Come on, we got to get to the next interview." But if you could shout out,
I can be reached at 949-300-3112, and it is best to text me, and I will return your calls personally. And once again, I thank you for having me on. I've enjoyed it.
Thank you, Blake, and thank you very much for coming on. Always enjoy the conversation.
Definitely. Have a good day.
And you too. That's Blake Adams from Accelerate Capital. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show to listen to us talk about real estate, talk about mortgages, talk about the ways you can take advantage. Had a couple of guests on the show today talking about DSCRs and P&L statements and ITIN number type loans. We usually go to the experts in this field in order to really get the penultimate answer to what the question is. Can I get a loan in this market? Can we afford a house? Can I move in a month, in 2 months? The answer to all those things is really rests on you as the borrower, but certainly on the availability of funds and the people that are out there doing the loans for you. And I bring to the show once again Charles Giscombe from Malibu Funding, who is the expert in those areas. Charles, how are you?
Great, Jeff. Thanks for having me again.
Yeah. Did you like that? Pentultimate? Did you like that?
I loved it. I love that use. I love that use of words. Yeah.
I have a bit of a wordsmith in me at times. Most of the time, I'm really dull-witted and can't put a sentence together. But when it comes to the radio, I seem to get up for it. So I appreciate you helping us out here today. Tell us what's happening in the market as we see the core inflation numbers drift downwards once again, and we're probably going to see the Fed stop raising interest rates tomorrow. So tell me what's happening.
Well, you know what, Jeff? I'll be honest with you. Obviously, the fire drill is starting to cease a little bit.
Yep.
And we're starting to see that we've reached pretty much, I would say, not the complete ceiling, but sort of the ceiling in regards to what the expectation of was for the interest rates to go up. But it's safe to say that we didn't get the complete panic that we faced before, because the market and the properties kept their value.
Right.
Even though interest rates were higher, the market was still moving. Things were still getting done. And the biggest thing was that there was still value in the properties. So investors and people alike weren't losing, weren't upside down, weren't seeing complete drops in their values, but things stayed consistent. And so with that being said, obviously we've learned a lesson from last. Like we tell people all the time, it's a cycle. And the industry and the market's going to go through that. You just have to understand that it's not going to, the bottom's not going to fall out. And so with that, we have to be proactive in telling our clients and our individuals that we're dealing with, Jeff, that there's still money out there for them to qualify for. for purchasing primary residence and investment properties. And although the traditional banks might not be doing it as much, there's still many other options out there in order for them to partake in this industry and this market.
I have a quick question for you, and it's an involved question, and you don't have to answer it if you don't want to. The bond market is what sets the mortgage interest rates. Everybody knows that. But in particular, we've had a very unusual time whereby in the last year we've gone from 3% to almost 7%. The people holding the paper on the 3% are looking at the people holding the paper on the 7% and are extremely envious. What's the strategy for those particular loans that look to be going to be on the books for forever to move the money in order to make more money? Because I think in a large sense, most people don't understand how mortgage interest rates work and why money is the cost of one day at 3% and a year later it's at 7%. They just don't get it.
Correct. The way the market moves that way. You're in a great market. Interest rates are down, and what happens is that people don't understand that those positions are taken. But now what people are doing now is you're starting to see new programs come out, standalone HELOCs, piggybacks, different things that can get people who still have good interest rates to transact in this market so they can get some of that 7% paper, Jeff.
Right.
And so a lot of times you're now hearing standalone HELOC, second piggyback, a fixed second mortgage that will record behind your first mortgage. A lot of times, a lot of these programs, there's always been home equity lines of credit and different things that you can do, but now they're becoming more prevalent because, like Jeff said, the 3% loans, people are not likely to move those loans, those interest rates, to refinance that. But there's still equity left, which goes back to that first piece we talked about, which was the values are still holding, which means that there's equity in there. People are appreciating and there's still equity. They're not losing. So in order to do that, what we do is we go in and we have these different programs that will allow you to get into the equity, to transact with the equity, and now you have an opportunity with the other banks and how the papers move to get a higher interest rate loan and still be involved. I hope I answered your question a little bit.
No, you did, and I think trying to figure that out, certainly from an investor, somebody who has money, who sells money, the federal government, the big banks, these are the people that are transacting in the hundreds of billions of dollars, buying money at one particular price and then selling it off. But as rates have risen, the money that was bought at the low end, they're making a ton of dough. And this is where the banks get into, profitability and shareholder price, all that kind of stuff, which really affects the availability of funds to you, the consumer who's out there just trying to get a loan.
Correct.
I don't know if that answers anything, but let's get into a couple of products. Give us an example of a couple of products right now which are active in the marketplace.
You know what? We just talked about them. So we have, there are traditional mortgages, of course, you can still get into that are roughly into the 7%. And like Jeff said, they'll be going down sometime soon. But if you're transacting right now and you're looking at that 7% interest rate, and you may not have the traditional documentation that a Fannie, Freddie, or Ginnie loan may require, and that would be 2 years tax returns or W-2s, paycheck stubs, 2 months of bank statements, just consistent traditional financial structure. A lot of people are working from home, transacting, but may not have that type of documentation. We always talk about it. There's non-QM loans, non-qualified mortgages that will accept alternative document types in order for you to qualify, meaning alternative documentation means bank statements, 12 months bank statements, right? Or a profit and loss statement, a CPA letter, different things that show people, that can show the lender that the individual investor or borrower has the ability to repay. That's the ATR we always talk about. And if you have the ability to repay, we have alternative options for you to qualify for so that the bank gets to know who that buyer is and are comfortable with you. Now, there are traditional banks that are involved with this non-qualified mortgage. A lot of times now there's private equity, there's hedge funds, different people that have a comfort level with this type of documentation. it allows individuals to transact in a market that they normally wouldn't be able to be in because they don't have the traditional financial documentation. And like we talked about before, these new programs that are coming along, if individuals do have investment properties or primary residence that they're looking for to get money out of, there's these standalone HELOCs and these piggyback loans, different loans that you can utilize to tap into equity so that you can continue to transact in this market and get qualified for. We love these type of loans. These loans are very helpful for individuals that don't have a traditional financial structure, and we're doing many, many more of them.
Yeah, I like the fact that the products are new. New products are always the way to entice borrowers to get into the market. If you're sitting on a ton of equity and you see prices stabilizing, if not going up, and they are going up in a lot of markets in Southern California, you want to take advantage of that rather than let that equity sit there. So in order to tap into that, you've got to get a higher rate mortgage, albeit a lot smaller than the purchase. But what we look for in the industry is a blended rate. Say you have a 3% and you get a 7% HELOC at $100,000. What's your blended rate? It's still pretty good deal for most borrowers.
Absolutely, Jeff. I completely agree. I'm actually selling a lot of that right now. Individuals are asking because now you also have the ability to do a non-QM standalone HELOC, which will allow you to do a DSCR or a non-DSCR, which is meaning that you don't have to debt service. There's some that offer no asset requirement. You know, these are great loans with different little tweaks and perks and value-added services to individuals that normally wouldn't be able to partake. And it's our job, and we do that at Malibu Funding a lot, is to do the research on the new products and find out what other options are out there for our clients. The key to it is I believe there's a loan out there for everybody. If you have the information, the knowledge, and you know how to research it, you can get someone qualified. You just have to take the time to figure it out.
Charles, we are at the end of our time together again. I'm sorry, that goes by very quickly. If you could shout out a way by which people can get in touch with you, that'd be great.
No problem, Jeff. You can reach me at that good old Vegas 702-328-5191. That's 702-328-5191. Or you can reach me by email at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Charles, thank you very much for coming on the show. I really appreciate it. Always do.
Thanks, Jeff, for having me.
Thank you. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, you can see this show at themortgagevoice.com. You can see it on YouTube, Jeff Barton, the Mortgage Voice. But if you want to hear what we're doing and you are a podcast fanatic, there are a number of podcasts out there that you can do that. I don't know if we've got a list up. Do we, Daryl?
Of course we do.
Of course.
But I was looking up 1050 AM and 106.5 FM. KCAA.
Oh, excellent. Thank you very much for looking that up. Appreciate it very much. So if you're out there, that's a place to see it. They have a number of podcasts associated with them, but so do we. And they are?
Coming up,
everybody. One place I know for sure is podclips.io. If you go to podclips.io, it's a great central location that you can find many of your podcasting needs, desires, and wants all in one place, whether it's lifestyle or finance, which is what we're on, or sports, or health. There are certainly many different experts there that you can get terrific opinions on what you should and shouldn't be doing, and certainly it's a terrific entertainment as well. Do you have the rest of them there, Darryl?
Yeah, thank you for stalling for me.
No, no problem. That's
Apple
a stretch in the
Podcasts,
business, right?
Spotify, Streaker.
It's a streaker.
Yes, Streaker, Stretcher, iHeartMedia, Radio.com, YouTube. You mentioned podclips.io, and of course, themortgagevoice.com.
Excellent. Thank you very much. Yes, those podcasts, podcasting has turned into something which is, you know, I tell people I'm on a radio show, and people say, well, what do you mean, your podcast? And I'm thinking, wow, what a difference a generation or two makes, right?
It's completely flipped, yeah.
It's completely flipped. People of a certain age have no idea what radio is. And, you know, it's funny because certain cars now are being they don't have AM radio stations anymore. You can't get them, which is interesting because in a couple of states that are going that way without AM are some of the people in the legislature trying to make sure that AM is available because, again, many people of a certain age, mine in particular, AM radio is still a staple in their lives. So
AM radio rebuilt the Republican Party from the ground up almost.
Well, you think about Mark Levin and, I'm just...
Rush Limbaugh?
Yeah, exactly. Oh, thank you. Rush Limbaugh. Rest in peace, Rush. But, yeah, absolutely right. And I just like AM radio because it reminds me of things that I did when I was a kid with a transistor radio. They don't have those kind of things today. They have the iPod and the fancy plug-in earphones, for $750. My transistor radio, I think, cost me maybe $11, maybe.
During my growing up, Vince Scully's voice came out of that in the summer.
Yeah, exactly. Okay, so
the voice of summer.
So in that same vein, I went to my 50th high school reunion over the weekend. Unbelievable, right? So 50 years. Think about that. If you're of my age, and that's into our late 60s. And you're thinking, wow, 50 years ago, where was I and what was I doing? Well, it was amazing because I went to this small little school. It was a private school back in Massachusetts. So I went back there for the reunion, and lo and behold, I think about 30 people showed up, which is apparently a lot. You're thinking about attrition, right? Or people moved away, or they're just, 50 years is a long time. But the interesting thing was, and this is what I think makes owning real estate the best, and really what you create memories. 50 years later, I see people, and all of a sudden, instantly, the memories of events that occurred that long ago come to, they just show up in your head, and you begin to share these things. Well, because I actually lived at this place, it was a prep school back in those days, and it was a completely different country than it is today. But home, like that school, is the same. So if you're not sure, if you're, can we afford it? Should I just rent? Maybe that's not for us. Let me tell you something. Having a home, everybody grew up in, most people grew up in the same house. I wouldn't say everybody, because there are certainly plenty of renters out there and plenty of people who move state to state to state, town to town to town. And for those people, I understand. I wish you all had a place to stay like I stayed when I was a kid, like this place. And that's what home ownership does for you. It creates memories, it attaches you to a place, and it gives you an ability to be able to give perspective on things that happened during the time that you live in the place that you live in. Daryl, you've lived in a number of different places recently. You know what that's like.
Yeah, being a radio guy, I've moved 27 times.
Oh, whoa, boy.
27 times. But from age 1 to 18, I was in the same house growing up with my family.
Okay.
Yeah. So I definitely understand.
Yeah, exactly. So in financing your house and trying to locate that property, it is a process. I've helped many hundreds, if not thousands of people get into homes, either through real estate or through loans, making loans to them. And my company, which has been around over almost 25 years, has helped many, many, many millions not millions, but thousands of people to do that. And the process to do that is gratifying. And I know that the stresses that you have, especially in today's market, it's a very uncertain time. It's an uncertain world, whether you're talking about inflation, whether you're talking about whether we're going to have a recession, whether you're thinking about the war that may or may not come home, whether you're thinking about this new round of explosion between the right and the left. Yeah, it can be really, really stressful. But home is a place where you can shut the door, control the environment, and enjoy what you have. And I think those long-term memories that you build, as well as the feeling you get, is why people say, hey, home ownership. Not to mention the financial gain, right? You own a home for 20 years. Let's say you have a child, you buy a house, and you're in that house for 20 years. You know that price, the house that you bought is going to be worth way more than the house you either sell or hang on to. And that's the way, as I always say, 90% of millionaires in America, that still means something, did it through home ownership. And doing it through home ownership in a place like San Bernardino, Riverside counties, or whether it's Los Angeles or Orange County or Palm Springs or Indio or any of these places in Southern California not on the beach is awesome. And I want to encourage you to get involved. Okay, let's get right to some news to use. As I said earlier, 6.97 is the 30-year, 6.34 is the 15-year, 6.66, you know what, I'm going to change that. 6.65, we don't want 3 6s. No, nobody does. Is the FHA, 6.70 is the jumbo, 6.92 is the 5-1 arm. The 2-year, as I said earlier, is at 4.58, and the 10-year is at 3.74. And we're seeing that 3/4 or 75 basis points gap between the two, usually portending a recession, but we're not quite sure yet because, as I said, the inflation. So let's just quickly get to inflation. The CPI number came out today, 4% year over year, and that's 0.1% month over month. The core inflation is at 5.3%. 0.4% month over month. The difference between the CPI and the core inflation is that core inflation cuts out energy prices and cuts out food prices, two of the most volatile measures in the CPI. We've seen some dramatic reductions in those particular things. I got a few items here. I'll just get to it quickly. Things that cost more now than they did a year ago and things that cost less. Okay, the motor vehicle repairs are up at 19.7%. We talk about what they call inflation, right? But there's a lot of greedflation out there. I think some of these categories that I talk about are really in greed inflation. I always pick on the oil industry and the gas that we have to pay here, but even back east, it's almost $5 a gallon there too. So it's not just California, it's everywhere. But I do think greed inflation is out there. Big companies, especially companies that control a great deal of the market that we're shopping in, really control the prices. And I think there's a lot of that. And I don't know how you deal with that other than just say, yeah, it's not the fact that we gave away billions, even though that is a problem. Obviously, oversupply of money is going to mean undersupply of goods to buy. Anyway, the motor vehicle insurance up 17%. Food from vending machines, 15.3. Pet food, 13.8. Medical equipment, 10%. Outdoor supplies, 10%. Baby food and formula, there was a big problem earlier in the year. That's up 10.1%. And rent of primary residence up 8.7%. Food away from home. Now, anybody that's been out and eating will know the bill is outrageous. Everywhere I go, restaurant prices have skyrocketed. Now, I think these people are gouging. It's my opinion. But nobody can tell me that because of the inflation everywhere, it affects doubling the price when you go out to eat. Anyway, I'm Jeff Barton, voice in the mortgage industry. Really appreciate you listening to the show today, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Legacy 1050 AM.